Hi everyone, welcome to my YouTube channel. In this episode, I'm going to talk about stock market basics. First, let's look at what is stock market. Then we will look at major stock exchanges around the world. And then I'll explain how to buy stocks in the stock market. And finally, we will look at the differences, pros and cons of investing versus trading. Most of you are watching without subscribing, so please subscribe my channel and support. And my name is Chris Sibamale. Here's my bio, and I have my disclaimer here. Anything that I say here is just for education and entertainment purpose only, and this is not a financial advice. I have put the disclaimer in the description box below as well, so please read it. So what is stock market? Stock market is a place or a platform where ownership of a business in the form of shares are sold and bought. When there are more buyers in the stock market than sellers, it is called a bull market. And when there are more sellers than buyers, it is called a bear market. Bear market is normally red and bull market is normally green. Because there are more buyers than sellers, during bull market, the price of a stock will go up. On the other hand, as there are more sellers than buyers in a bear market, the price of a stock will generally go down. And stock market has some other names as well, such as share market, equity market, stock exchange and securities exchange. Now let's look at the largest stock exchanges in the world. First one is of course New York Stock Exchange, followed by Nasdaq and Tokyo Stock Exchange, Shanghai Stock Exchange, Hong Kong Stock Exchange, London Stock Exchange, Euronext, Shenzhen Stock Exchange, Australian Equities Exchange, Toronto Stock Exchange, Bombay Stock Exchange, National Stock Exchange of India. These are the main stock exchanges around the world, but there are many more stock exchanges probably in many other countries as well. Now let's look at how to buy and sell stocks. In order for us to buy and sell stocks in stock exchanges, we need stockbrokers. It can be a full service broker or it can be an online platform or discounted broker. Let's look at the difference between the full service broker and the discounted or online brokers. So the full service brokers, as the name says, provide full service, including managing all of your finances. So basically you give full service brokers the money and they decide where to and how to invest. However, full service brokers are more expensive because they charge hefty fees. Unless you have millions of dollars in your bank account and you want to invest, for small investors, it's pointless going to a full service broker because we don't have enough money and we can't afford their service. Retail investors and small investors, the best option is to go with the discounted brokers or online platforms. Examples of full service brokers are like JP Morgan, Goldman Sachs, Morgan Stanley, Citigroup, Wells Fargo, UBS, HSBC, Barclays, RBC Capital Markets, BNB Paribas, and many more investment banks like that. Now let's look at discount brokers. Online or discount brokers means the online platforms that we buy and sell shares for, say for example, Charles Schwab's, Robinhood, TD Ameritrade, Fidelity Investment, CMC Markets, IG Group. These platforms are far less expensive compared to the full service brokers. But the problem here is they don't provide any investment advice. They provide general advice and educational materials, but they don't provide any investment specific advices. And therefore, we have to manage our own investment. And that means we will have to do a lot of research before we investing into a stock or any other investment security. I will have to warn you though, before you choose an online broker or full service broker, you got to be really careful because there are so many hackers pretending like stock brokers, and then they can take your money easily. So you got to be really careful. Alright, now let's look at how to trade using a broker. First, you have to open an account with the broker and then select the unique stock symbol. Each stock in every stock exchanges has a unique stock symbol. Just for example, Apple stock is called AAPL. Once you have selected the stock that you are going to buy or sell, then you have to price quote with a bid or offer price. Now let's look at what is bid and offer prices. Bid means the highest price someone will pay for a share. Like if I'm a buyer and I'm going to buy a stock, what is the maximum price I'm ready to pay to get that stock, which is called bid price. Offer or ask is the lowest price someone is willing to sell a share. The difference between the bid and offer is called a spread, which goes to the market maker. Now, once you have decided on the offer or bid price, you have to place the order. There are two types of order. One is market order and the other one is limit order. So the market order means buying or selling at the current market price. The orders will be executed straight away because the market is open. The other one is the limit order. Limit order means setting a specific price at which to buy or sell a stock. And the orders will be executed when or if the price reaches that level. Limit orders are normally used during pre-market and after hours because the market is closed during this time. Now you can use two options here. One is stop loss and the other one is take a profit. Say for example you bought Tesla share for $400 and then the price started dropping. So you can set that stop loss at $300, and if the price drops to $300, your shares will be sold. And if the Tesla shares continue to drop $200, you can avoid further losses. On the other hand, you can set the take a profit price as well. Use the same example. You bought the Tesla share for $400 and you can set the take a profit price at $500. And if this Tesla shares reach to 500, your stocks will be sold at 500 and therefore you will be making $100 profit per stock. Once you have placed the order and when the orders are executed, you will receive a fill or an order confirmation. This is how an order confirmation looks like. So you will have the buyer's confirmation details, account number, confirmation number, transaction date and settlement date. And then you will have your mailing address. You will have the stock symbol and the detail of the stock you bought, the price you bought and the number of quantities you bought and total amount you paid. And here you will have the confirmation details, order is completed, average price you paid and any exchange rates, fees, etc. and other conditions if applicable. And there's another section here called crossed. This means the stock was possibly bought during after hours or during pre-market, because what this crossed means is the broker has matched the buyer and seller within their platform instead of going to the stock exchange itself. And this transaction will be recorded when the stock exchange opens. And you will have the brokerage fee paid and all other fees paid and the total amount you paid to the broker to buy the stock. Now let's look at investing versus trading. Investing means it's a long-term approach. Just like you plant a seed and it becomes a sprout and a seedling and a sapling and a grown-up tree and it starts to fruit, right? It could take from 5 to 10 years before it fruits. Just like that, investing is also a long-term approach. You will have to ignore the short-term losses with the hope of getting a long-term gain. So basically, investing focuses on the performance of the business, and the investors ignore the short-term price fluctuations in the market, and investors use fundamental analysis to evaluate the business performance. And in coming videos, we will look at what fundamental analysis is and how to apply fundamental analysis to evaluate the business performance. So please subscribe and click the notification button. So when I upload the videos, you will get a notification. So basically this is a patient and slow strategy. But trading is a short-term strategy, and traders attempt to make profit quickly from the price fluctuations in the market. As you can see, trading is a high risk, high return strategy, and traders usually use technical analysis to pick a stock. And again, I will be talking about what technical analysis is and how to apply technical analysis in coming videos. So please subscribe to my channel and click on the notification button. And trading, as you can see here, is a boom or bust strategy. And if it booms, you will probably end up like this old man in a beach with beautiful girls, but 90% of the time traders go broke like this. So you have to choose your strategy very carefully. Now let's look at the pros and cons of investing and trading. So the downside of investing is of course the risk that comes with. You could end up losing your capital. So capital loss is there, liquidity risk is there. Say for example, if you invest all your saving and you want some cash urgently, you can't convert the stocks immediately into cash because it could be down in price and you could be at a loss. So there's a liquidity risk, volatility risk, of course, the price goes up and down all the time. Currency risk, if you are investing into US dollars using another currency, there's a currency risk. Legislative risk, the decisions made by each government can significantly impact the stock price, so you have to be prepared for it as well. The next downside, especially in long-term investing, is fear of missing out, or FOMO. What it is basically, if you are planning to buy Microsoft shares for $250, say for example, but the share price went to 270, you are thinking maybe the price will come down. The next day it went to 290 and you still think the price will come down. The following day it went to 320. Now you start to panic because you are going to lose all the amazing returns the Microsoft stock is going to bring you. And then suddenly you invest your money into Microsoft stocks at $320 per share. The next day it drops to 290 and the next day it comes down to 240. Now you are at a loss. Even though your strategy is long term, sometimes to make up these losses it could take years. So you have to basically avoid this FOMO. And the next challenging thing in investing or trading is picking the individual stocks, because picking the individual stock can be very time consuming and you will have to do a lot of research. Now let's look at the advantages. Of course, capital gain. When the stock price goes up, you will be making capital gain, and there are dividend income for some stocks, not all of them. We will be looking at the difference between dividend stock and growth stock and every other stock in coming videos. And of course, the financial independence. This is a passive income pathway, so it opens the door for financial independence as well. I have to tell you one thing though. The only certainty in the financial market is uncertainty. So when you make investment decisions, you got to be really careful, and you should probably invest the amount that you can afford to lose. Thank you for watching, and I will see you in another video. Please don't forget to subscribe to my channel. Thank you.